In 2018, tariffs hit like thunder. America versus China, the biggest economic fight on earth. Everyone expected money to run for safety. But behind the shouting, Wall Street did the opposite. BlackRock, JP Morgan, Goldman, firms that read risk for a living, kept pushing deeper into China as the trade war intensified. By 2020, U.S. exposure to Chinese securities was being estimated in the trillions. So what were they seeing that the public wasn't? This isn't a simple greed story, it's a hidden machine. Number one, origins. The back door that made China hard to avoid. For decades, China's rise followed a deliberate sequence. Factories first, finance last. The country welcomed global manufacturing, exports, and foreign direct investment, but it treated its financial system like a controlled vault. Capital controls limited how easily foreign money could enter and exit. Foreign banks faced tight restrictions, and many Western firms were forced into joint ventures that capped ownership and influence. This design wasn't accidental. It reduced the risk of sudden capital flight and kept Beijing in command of credit, currency stability, and strategic industries. So even as China became central to global trade, Wall Street's role inside China remained limited, like a guest invited into the lobby, but not allowed upstairs. Then the global environment changed. After the 2008 financial crisis, interest rates fell across the US and Europe, and huge pools of money, pensions, insurers, and asset managers, entered a long era of yield hunting. At the same time, China's domestic markets became too large to ignore. Deepening bond markets, fast-growing equity markets, and a rising middle class turning savings into investment demand. Beijing also began opening financial channels that still preserved control, like allowing foreign participation through regulated access programs and gradually loosening ownership limits. This wasn't full liberalization. It was selective opening designed to attract capital without surrendering authority. But the real turning point, the backdoor, wasn't a speech or a treaty, it was index inclusion. When major index providers start adding a country's bonds or stocks into benchmarks, global money moves automatically. It's not about emotion or politics, it's about rules. Passive funds and benchmarked investors must buy what the index contains, and even active managers often hug those benchmarks to avoid underperforming. Once China began entering global indexes, the decision stopped being, do we like China, and became, can we afford to be underweight China? That shift quietly set the stage for everything that followed. Because once finance becomes default, politics has to fight an uphill battle against momentum. Number two, rise. How Wall Street positioned itself before the storm. When China began loosening financial restrictions and opening select market channels, Wall Street didn't wait to be invited. It sprinted to the front door. By 2016-2017, the world's largest financial institutions had quietly built long-term strategies to capture China's growing capital markets. For firms like BlackRock, JP Morgan, and Goldman Sachs, this wasn't a short-term trade. It was a structural bet that China's financial system would become a core pillar of global investing. And they saw opportunity where others saw risk, and they knew that early positioning could mean controlling the first wave of foreign capital inflows once Beijing gave the green light. For BlackRock, the logic was mathematical. As the world's largest asset manager, its power comes from indexing, building funds that automatically mirror global benchmarks. When index giants like MSCI and FTSE Russell began adding Chinese securities to their global indices, BlackRock had no choice but to prepare. Passive investment money follows those indices automatically. That meant every pension fund, sovereign wealth fund, and retirement portfolio benchmarked to MSCI emerging markets would soon hold more Chinese stocks and bonds, whether they liked it or not. For JP Morgan, the opportunity was in infrastructure. By handling custody, settlement, and derivatives trading, it could profit from every transaction flowing through these new financial channels. And Goldman Sachs focused on the top of the pyramid, wealthy Chinese clients, IPO advisory, and financial products tailored to a market expected to mint new millionaires by the millions. This quiet alignment happened just before the storm broke. By the time Trump launched the trade war in 2018, Wall Street was already locked in. Billions were committed to funds and platforms designed to integrate China into the global financial web. So when tariffs struck and headlines screamed decoupling, the real story beneath the surface was the opposite. American finance had never been more coupled to China's future. Number three, breaking point. The trade war shock that should have stopped the money. When Trump's trade war officially ignited in 2018, the logic sounded simple. Tariffs would make China less profitable, less reliable, and less investable. Companies would shift supply chains, consumers would pay more, and Beijing would be forced to bend or break. On paper, that kind of conflict should also chill Wall Street, because markets hate uncertainty, and a prolonged US-China clash isn't just risk. It's the kind of risk that can reprice everything overnight. Currency tensions, sanctions, export controls, delistings. even the possibility of financial restrictions. If the relationship was turning hostile, why wouldn't the biggest asset managers and banks hit pause? But that's where the story flips. The trade war attacked physical trade, containers, factories, import costs, yet the financial system ran on a different set of incentives. For many large funds, the question wasn't, should we invest in China? It was, what happens if we don't? Because once China was entering benchmarks and market access was expanding, staying underweight could mean years of underperformance if Chinese assets rallied. And even for active managers who wanted to be cautious, they still had to manage against a benchmark reality. If China's weight inside global indexes grows, then not owning it becomes an active bet, one that can get you fired if you're wrong. That's the hidden breaking point. Politics can declare a fight, but portfolio mechanics keep marching forward. Meanwhile, Beijing responded to pressure in a way that surprised many observers. Instead of slamming the door on foreign finance, it signaled selective opening. Not full freedom, but strategic access, enough to attract global capital, deepen liquidity, and prove that China's markets could function as global infrastructure rather than a closed experiment. And Wall Street read those signals like professionals. Conflict in headlines doesn't always equal closed opportunities in reality. So the breaking point wasn't a moment where money stopped. It was a moment where the system split into two lanes. Trade relations worsened, but financial channels kept widening. That divergence is the key to the mystery, because it explains how, in the middle of a trade war, the world's largest financial institutions could still justify building deeper roots inside China. Number 4, fallout. The quiet wave of approvals that changed everything. By 2019 into 2020, the trade war had already reshaped headlines, but the real fallout happened in boardrooms and regulatory filings, places most people never look. This is where the story becomes less about tariffs and more about access. Because in finance, access is power. If you can operate inside China's domestic market, sell products, manage local funds, run trading operations, you're no longer just investing in China. You're becoming part of China's financial ecosystem. And once that happens, leaving becomes harder because your business isn't only exposure anymore. It's operations, clients, staff, and permissions. What followed was a series of approvals that looked almost surreal when compared to the political hostility of the time. Major Western firms began securing deeper footholds, full or increased ownership stakes, expanded licenses, and the ability to run businesses that previously required local partners. Each approval acted like a signal flare to the market. China isn't closing, China is inviting. And when a market that large invites global finance, capital doesn't just trickle in, it accelerates. It brings liquidity, products, more index weight, and more justification for global investors to treat China as normal in a portfolio. This fallout created a reinforcing loop, a cycle that kept feeding itself. Step 1, access improves, making it easier to buy and sell Chinese assets. Step 2, easier access encourages index providers and global portfolio managers to include China more confidently. Step 3, inclusion drives passive flows, and passive flows deepen the market further, which then justifies even more inclusion. In other words, the fallout wasn't a crash. It was a system quietly building momentum while the public was distracted by the trade war drama. And that's how the mystery number, the huge scale of U.S. exposure, starts to make sense. Because large numbers don't appear from one decision. They appear from repeated decisions that feel small in isolation. A license here, a benchmark change there, a new ETF product, a new channel for bonds, a new partnership, a new client mandate. Add those up over a few years, and suddenly the world wakes up to a reality it didn't vote for and barely noticed. Financial integration expanded during the trade war era, even while political trust collapsed. That's the fallout. Less visible than tariffs, but far more lasting. Number 5, failed fixes. Why decoupling? Didn't decouple the money. Once lawmakers and regulators realized how deep the financial links were getting, the next question became urgent. How do you reduce exposure without detonating your own system? And that's where the fixes started. Warnings, proposals, tighter scrutiny, delisting pressure, and political messaging designed to make China feel radioactive. In public, the narrative sounded strong. Limit dependence, protect national interests, reduce risk. But in practice, the financial machine doesn't reverse easily because it isn't built like a light switch. It's built like a network of contracts, benchmarks, mandates, and incentives, each one locking in the next decision. One reason these fixes struggled is simple. The exposure wasn't always obvious. Chinese companies often raise capital through offshore structures, subsidiaries, and listings outside mainland China. Capital can also flow through intermediaries, funds, and cross-border pipelines that blur the true end destination. That meant policymakers were trying to manage risk while the map kept shifting. Even when rules tightened in one area, money often rerouted through another channel. Like squeezing a balloon, press one side, the pressure pops out somewhere else. The system adapts faster than politics because finance is motivated by survival and performance daily, quarterly, relentlessly. Another reason is that much of the exposure wasn't driven by dramatic China bets, but by benchmark gravity. Index-linked funds and benchmark-aware managers move with the weight of the index. If China's weight rises, they buy. If they don't, they risk falling behind peers. This doesn't feel ideological, it feels mechanical, like showing up to a race where everyone else has a better vehicle. So even investors who privately worried about geopolitics faced a professional problem. Underweighting China could mean underperforming, and underperforming can mean losing clients. That pressure created a silent discipline. Don't be the one who misses the rally, even if the headlines are ugly. And then there's the hardest truth. Decoupling isn't free. If you restrict capital too aggressively, you can hurt your own pension funds, your own market liquidity, and your own financial firms competing globally. So the fixes often became half measures, strong enough to signal toughness, but not strong enough to unwind the full structure. That's why this phase is called failed fixes, not because nothing changed, but because the changes couldn't break the deeper loop. Politics tried to slow the flow, but the incentives of modern finance kept pulling money through the cracks. Number 6, modern parallels, the pattern that keeps returning. Here's the uncomfortable part. This isn't just a Trump-era story. It's a blueprint that keeps repeating whenever geopolitics collides with global finance. First, a shock hits, tariffs, sanctions, military tension, or diplomatic crisis. The public expects a clean break, and then markets wobble, commentators announce a new era, and everyone waits for the money to leave. But instead of a clean exit, something else happens. Capital adapts. It reroutes through new instruments, new listings, new intermediaries, and, most importantly, through the passive and benchmark systems that don't care about speeches. That's the modern parallel. The system's default setting is still integration, unless you rewrite the rules that silently govern the world's portfolios. And the repeating pattern is always cause and effect. Access expands, even slightly, and that creates liquidity. Liquidity makes markets more investable. More investable markets get heavier index weight. Heavier index weight forces automatic buying. Automatic buying deepens liquidity further. Then, once exposure becomes normal, it stops feeling like a decision at all. That's how you end up with massive numbers that shock ordinary people, because the growth wasn't one dramatic moment. It was hundreds of small, reasonable steps. This is also why the next crisis always feels surprising. People assume money will behave emotionally, but modern finance behaves structurally. Now compare that pattern to what we see today in other arenas. Supply chain shifts that don't fully leave China, technology restrictions that still coexist with trade, and risk reduction language that often stops short of full separation. The surface story changes, but the mechanics don't. Money follows access, scale, and benchmark design. And because China is so large, even cautious investors struggle with the same fear. If China is a major chunk of global growth or global market structure, can you afford to ignore it without paying a performance price? That's the same psychological trap the trade war era exposed. So the modern parallel isn't just history repeats, it's this. Global finance creates momentum that outlives political cycles. Leaders change, slogans change, tariff rates change, but the architecture of indexes, mandates, and market access keeps pushing portfolios toward whatever is systemically large. That's why the real question going forward isn't whether the next shock will happen. The real question is whether policymakers and investors will finally confront the hidden engine, the rules of allocation that keep turning geopolitical rivals into unavoidable portfolio holdings. 3. Takeaways. 1 warning, and what happens next. So now the mystery has an answer. The reason giants like BlackRock, JP Morgan, and Goldman kept moving toward China during Trump's trade war years wasn't because they didn't see the conflict. They did. It was because the financial machine was running on forces stronger than headlines. Index inclusion, market access benchmark pressure, and the enormous fee opportunity of being the bridge between global capital and China's domestic markets. Tariffs hit goods, but finance followed a different logic. Access plus scale equals inevitability. And the result was deeper entanglement at the exact moment the public expected separation. Takeaway. For 1, trade and finance are different battlefields. A trade war can shrink imports and disrupt supply chains, but capital can keep flowing through securities markets, especially when global benchmarks quietly increase exposure. If you only watch shipping containers, you miss what's happening in portfolios. Takeaway number 2, indexes can move trillions without a debate. When China enters major benchmarks, investors don't need to decide to buy China. Many are forced to, or pressured to, just to keep up. The biggest shifts often happen quietly, through rules, not speeches. Takeaway number 3. Access is the real prize. China didn't respond to pressure by shutting the door everywhere. In key moments, it selectively opened finance, because foreign participation can deepen liquidity and make the market more globally essential. Wall Street chased permissions because permissions become permanent advantage, a warning and an open-ended thought. If exposure can grow during open hostility, what happens during the next shock, when everyone tries to exit at the same time? The real danger isn't just investing in a rival, it's discovering that you're more connected than you realized, and less able to leave than you assumed. If you want part 2, I'll break down exactly how indexes and passive funds auto-buy countries, and how that hidden system affects ordinary people's pensions and retirement accounts. Until then, comment one word: inevitable. If you think money will always find a way, or decouple, if you believe a clean break is coming. And if you learned something new today, subscribe, because the next story will show you who really controls the flow of global capital when politics turns into conflict.